Hi, my name is Nick Kiriopoulos and I'm the CEO of Peterson Group. We're an accounting and financial planning firm. Today I'll be talking to you about strategy number 2 of our 5-part series for tax planning for 2015, protected share investments. So what we're talking about in this video is how you can buy a parcel of blue chip shares by using capital protection, so you cannot lose your money if the share market goes down. At the same time, if you prepay your interest for the shares before 30th of June, you can get a tax deduction in this financial year. Now, why is this important? Apart from the general tax planning strategy you can have by bringing forth expenses if you're going to pay for certain items from a tax deduction point of view, superannuation is one thing you can do. Prepaying interest for share investments that are capital protected is another option. With the solid performance of equity markets over the last 9 months, we've seen a significant amount of interest by investors looking to leverage back into the share market with the benefit of capital protection and tax efficiency. This, coupled with a reduction of volatility of shares and reduced borrowing costs of recent times, have made share investments as attractive as ever. So you can borrow, let's say, $50,000 from the bank to purchase 50,000 of blue chip shares, and you do this all before 30th of June. Some banks will lend you a further amount for you to use immediately to pay them back for the prepaid interest on the original $50,000 loans for the next 12 months. Assuming the ATR allows a tax deduction of 6.95% for the interest and that your individual tax rate is 49%, using this strategy would result in a new tax deduction for you of $3,475. This will result in additional tax refund to you of $1,702. You receive all dividends from the shares throughout the year and you maximize your tax refunds, and you're basically outlaid no money. So if you use a capital protected share investment, your shares are 100% protected. This means that if the share market goes down, you don't lose any capital, and your shares go up in value, you keep all the upside. This is ideal for investors who want to have share investments but who don't want to have any chance of losing their capital. Now, what sort of shares do we use in these sorts of investments? Well, generally speaking, we try and look for blue chip share opportunities, something in a good, strong, consistent company like BHP and ANZ as an example. A company that has good growth potential, but also the ability to pay consistent dividends as well. And that's the key, because if you do this, it's just a normal share investment. You have all the dividends in your name. You pay interest and you're paying back the interest repayment loan, and you're getting a big tax refund in July, August, based on the amount of interest you've prepaid. And it starts at $50,000. You can put that up. We've had some clients basically do it for $100,000. We've even had one client that has done it for $1 million. So it can be whatever you want it to be. So it really comes down to how strong your cash flow is and what surplus cash you might have, what level of assets that you have, and how much tax deduction you want to get. As we said, it's allowing you to, with zero cash out, have an investment in shares that are capital protected, which is normally for a 3-year period. So if the shares go up in value, you get all of that. If any of them go down, you don't lose any of your money on any of the individual shares, no matter what they're in. So it's a great option to consider. So if you're looking for some tax relief by leveraging back into the share market, but want the added security of 100% capital protection, contact us today, and one of our highly qualified financial planners will discuss your financial circumstances with you and provide you with a statement of advice tailored to your circumstances. It's a great option to consider, so contact us here at Peterson Group on 9381 1500 before it's too late.